Congratulations, you landed the job. Whether it's a new job or your first one, it's important to understand the benefits that you get from your employer and how they impact your financial plan. I'm Kyle Kuyat, a certified financial planner and co-founder of Defining Wealth. And in today's video, we're going to dive into all the things that you need to know about your employer benefits so that you can take advantage of them. First up is your employer-sponsored retirement plan. While retirement may seem a ways away, it's crucial for your financial future. While there's many different types of plans out there, the most common and the one that most people are familiar with is a 401k plan. So now that you know that you have a plan, how do you take advantage of it? The first thing you want to look out for is to see if your employer matches your contributions into the plan. This is called a match. The last thing we want you to do is be leaving money on the table, especially when your employer is putting it out there for you. For example, a 401k plan might offer a match of 100% up to 3% of your compensation, and then match 50% on the next 2% of your compensation, which would equal a 4% match. Let's say your annual salary is $60,000 a year, and you contribute 5% of that, which would be $3,000, while your employer is going to match another $2,400. This is why more often than not, it's advantageous for you to contribute up to the maximum that your employer is going to match. Otherwise, you're leaving money on the table. How much money are you leaving on the table? Well, let's take this example one step further. For example, if your total annual contribution is the $5,400, $3,000 from you, and $2,400 match from your employer, assuming you had a 7% return that was compounded annually over the next 12 years, you'd have $96,597. More often than not, that's a pretty fair trade-off whenever you only been contributing $3,000 a year on your end. Now, whether or not your employer offers a match for your 401k plan is one thing, but it may be also important to consider the tax benefits that you get from contributing to your 401k regardless. Traditional 401k contributions are going to be tax deductible, and they're going to reduce your taxable income. Using our same example, let's say that your salary is $60,000 and you contribute $3,000 per year. Your taxable income would fall from $60,000 to $57,000 if your tax rate was 25%, and that's a total tax savings today of $750. So that's a high-level example of how your retirement plans within an employer are typically going to work. But let's move on to some of the other benefits that you may have. Now, it's no secret that healthcare in the United States is and can be extremely expensive. That's why employer-provided health insurance may be one of the most crucial benefits that you're able to receive. However, just like retirement plans, health insurance is not always created equal. That's why learning about the coverage you have today can help you avoid surprises and problems in the future. At the most basic level, employer-provided health insurance falls into two categories. An HMO is a health maintenance organization, while a PPO is a preferred provider organization. Typically, HMOs are going to be lower costs, while PPOs are going to be more flexible. Regardless of your age, taking care of yourself can be one of the most cost-effective ways to prevent healthcare costs in the future. But health insurance isn't where it stops when it comes to your employer benefits. For example, disability insurance will compensate you if you become disabled and are unable to work. Statistically speaking, whenever you're younger, disability is one of the highest risks that you have when it comes to being an employee. So don't overlook this. Your employer may also provide life insurance, which can be important, especially if you have those that are dependent on you, whether it be your spouse, kids, etc. Now, when it comes to these additional life insurance and disability options, at the employer level, it's typically going to be in a group format, which means that normally these plans are going to be at a lower cost than what it would be for you to go out there and get it by yourself. While they may be cheaper, the caveat is that these group plans are often less flexible than an individual plan, and they typically have limits as far as how much coverage you can get. If you are going to sign up for the life or disability insurance through your employer, make sure that you do consider some other options out there to compare the rates and the coverage that you can get through your employer versus just by yourself. I talk about this a lot on this channel. How you do one thing financially can affect other things when it comes to your financial plan. Your plan and your employer are both unique to you. There may be some that have tuition reimbursement, employee stock options, or health savings accounts, just to name a few. These can all be huge benefits that your employer provides that may impact your financial plan. Your HR department should be able to give you a baseline as to what these benefits are where you're currently employed, But if you do want additional guidance and help on things beyond your employer benefits alone, make sure you contact a certified financial planner and they'll be able to walk you through it entirely. My team and I at Defining Wealth are certified financial planners, and we're always happy to have a conversation. So there you have it. Now you know and understand your benefits more than you did whenever you started this video. If you want to continue to learn more about personal finance, make sure you go ahead and click subscribe. Again, I'm Kyle Kuyat, and I will see you guys next time.